All right, here we go. Here we go. Good morning, Rawls Group. How are we doing this morning? I don't know. I'm not feeling that too much. Got it. Let me hear it. How are we doing this morning? All right, that's great. We're going to pretend in the stadium that we're at Disney, and let's all just scoot in a few so that we can have some stragglers that can have some space. If you'd be so kind, we appreciate that. Thank you. And as we get ready to welcome everybody, this is wrapping so that we have now first quarter stats. Very exciting information to be able to share. Goal here is for you to be armed with the data, with the statistics, with the knowledge that makes you your database's local economist of choice. When you have this data, when you have this information, and when I say have, I mean when you own it, when you're able to speak to the days on market, when you're able to speak to the different categories of prices that are price reduced, not price reduced, and then that other category, right, the failed listings. When you're able to speak to those things and you're able to do it quickly and with confidence, your database, your clients, and people that you're just in conversation with, here's the deal. They look and they pay attention. Want to know why? Is because in the United States of America, the majority of Americans' wealth rests in one place, and it's not the stock market. What is it? That's exactly right. It's the equity in their home. It's the number one place that people have wealth stored. And we are their advisors, their trusted advisors, as they go through that process. So we appreciate you being here to sharpen your skills, to increase your knowledge, and to grow your business. Thank you very much. Let's start off. Who have we got at the Rawls Group from our Perimeter Funwoody Market Center? Let's see ya. All right. Okay. All right. Okay. Let's go with Cityside. Do I hear Cityside? All right. Okay. All right. Let's go with my home market center, East Cobb. All right, East Cobb coming up. All right, what about little in town, Brookhaven? What have we got? Peachtree Road. All right, there's just one left. We got to see. Peachtree Road, I think, is in the lead right now. First Atlanta. All right, I'll let y'all judge. So, as we get ready to jump in, the first thing that we want to do is I want to thank the people who make this possible. And I'm going to start with our staff at First Atlanta. Cara, you and the team do a fantastic job putting all this together. Absolutely. And without whom this would not happen, our sponsors. So Supreme Lending, who we have Luke Hale here today, McMichael and Gray, Campbell and Brannon, and Atlanta Peach Movers. So thank you very much to our sponsors. Okay, we are going to welcome Luke Hale to the stage to join me as we go over our national stats. Thank you.
I like the walk-up music.
That's right. Very good. All right, so the national stats. We're going to start macro, and then we're going to dive down as we go local and into specific segments in that market. All right, here we go. So gross domestic product. Now, this is annualized. So when you see this for 2025, you go, whoa, what does this mean? Well, they took the first quarter, and they said if that trend continues over the course of the year, this would be what the annual GDP growth would be for the year, and that's 1.7. The reason 2.8 is in purple is because they typically will come back over a 3 to 6 month period, and they'll revise once they actually get the data and stats and all the firm numbers and reporting in. So forecasted GDP growth, okay, is 1.7%. Now, that's a positive forecast, okay? There are other forecasts that have different projections there, right? And they range anywhere from this positive 1.7 to anywhere to negative 2%. And I just want to have a little quick context on what this is. So the gross domestic product for the United States of America, this is all the products, goods, and services that are sold in the country for a period of 1 year. Any idea what that number is? Anybody? Let me just throw something out. $1 trillion. Great guess. Okay, it is in the trillions. All right, so it's $29 trillion. Right? Okay. All right. So when you see a plus 1% or a plus minus 1%, know that that's about $100 billion. Right? Okay. All right. So just as you look at these numbers and think about it, it's or $200 billion. Right? So I just want you to know that as this goes up or down, it doesn't mean that we're going out of business, right? If it goes down, a recession doesn't mean that we're going out of business. It means maybe you have 1 or 2% less. Think about it. If you made 1 or 2% less money or 1 or 2% more money, would that make a massive impact on your life, right? Okay, so just, as we go through this, recession or positive growth, right? Factor that in.
We got unemployment versus job openings. Something that I think stood out to me was that in 2022, actually July of 2022, job openings was in a ratio with unemployment such that there were 2 job openings for every 1 unemployed person. Now you can see that gap closing, and we're at a spot where it's roughly 1 to 1. That is indicative of a weakening labor market. At the same time, though, we'll see the unemployment right now is 4.6%. Healthy range for unemployment is 4 to 5%. So we are in a pretty healthy spot as far as unemployment goes. So 2 sides of the coin there.
Love it. Thank you, Luke. All right. The dreaded I, inflation, right? Here's where we're at today, along with some future projections, right? And we know that one of the big things that's driving interest rates is the Fed watches this number, and they say, okay, is inflation coming down, right? They've got this mythical goal of 2%. Yes, I said mythical. But it's just a target. It's where they like to see it trending toward. Between 2 to 3 is kind of average. If you actually look at what the average inflation rate is over time, it's about 3%. Okay, so they're trying to get to 2 to be below what the average is. So what we see here is in 2025, right now projected, is in that 2.8, 2.9 range. The difference in these two, so the yellow line and the, I don't know, we'll call that green line, okay? The green line is core CPI, the yellow line is CPI, okay? So consumer price index, right? The consumer price index includes the stuff that makes things go, food and energy. Now, I've kind of always laughed, core CPI, I'm like, why would we take out and say a measure of inflation and we take out everything that makes something go, right? But that's what they do. So we go core CPI, it excludes food and energy, and you see that that number is a little bit lower. The Fed actually prefers that number because volatile things like food and energy, or food and gas and that kind of thing, they're very volatile. So to measure long-term inflation and how it's trending, the Fed does prefer core CPI. So you see, good news, this is all trending in the right direction. We're going to talk about kind of why aren't we seeing that reflected in interest rates, and we'll do that a little bit later. Oh, cool.
Mortgage rates. The big keyword here is stability over the last couple of years. So you can see the horizontal bars towards 23, 24, 25 being fairly flat. They've been kind of stable at upper 6s up to right around 7%, which is a good thing in terms of stability, right? I believe that consumers, when faced with instability, suffer from uncertainty, and that hinders decision making. So when there's stability, they are, engaged and promoted to make really good decisions and able to make a decision on the biggest investment of their life, which is typically a home.
Look, I think that's brilliant to bring up, because certainty versus uncertainty, right? If things are stable, how do people feel, right? I love that. Thank you.
From a month,
Sorry.
All good. From a monthly perspective, you can see a little bit more volatility because it's less long run. So we see the bond market going up and down. But still overall, in the last several months, it's been right around mid 6s to upper 6s, which again echoes some stability, which is good for decision making.
Luke, for just a second, would you talk to the bond market and interest rates and just kind of give a quick explanation of that?
Sure, of course. Yeah, the bond market is where we see long run. When I say long run, I mean 30 years, which is a mortgage. While we tie mortgage rates to the bond market, In the bond market, we see individuals buying, as opposed to the stock market. Let me walk back and say, there's two big markets. There's the stock market and there's the bond market. Individuals will typically buy into one or the other depending on risk. When things look a little bit less risky, they'll buy into stocks, and you see stock prices go up, and they'll move money away from the bond market to do so. When things look a little bit riskier, maybe recession's impending, they'll move money from the stock market into the bond market. That will cause bond prices to increase and therefore their yield to drop. Mortgage lenders tie interest rates to bond yields, so when that drops, mortgage rates fall. Was that the answer you were looking for?
I love it, because I think linear a lot of times. And so when they say, oh, well, the bond's up, but then they go, but the interest rates are down.
Yeah,
and
there's
I'm like,
an inverse relationship
yes,
there. So when
thank
bonds
you.
are up, interest rates fall. That's because
Yes.
the yield of bonds drops when the price goes up, and mortgage lenders tie interest rates to that bond yield.
Perfect.
Exactly right.
Love it. Thank you. Because that's always something that I've thought about. And I'm like, the bond, they say the bond goes up and then the interest rates fall. And I'm like, what? But so what we've also seen is that currently with the Fed bringing the federal funds rate down, but we've seen the interest rate be stubborn, right? And it's because bond investors are betting against what the Fed's trying to do. And the reason that they're betting against this is because of the national debt. So they're saying, hey, you're going to have to address this national debt at some point. So yeah, you can lower this federal funds rate, but we're betting that you're going to have to make some other moves in order to long-term address that. So it's kind of interesting to see the way that that's playing out right now. And that's why interest rates are being a little bit more stubborn right now, even as the Fed has lowered the federal funds rate. All right, Luke, let's tag team this one.
Sure. What do you see on this one?
Well, what's the biggest number, right? No mortgage, 35.2 million homeowners, which is almost 40%, right, of 88 million.
Yeah, that's a lot of equity. So there's a lot of equity in America right now, and truthfully, what I see when I see a lot of equity is I see a lot of opportunity. So that might be opportunity to potentially use that equity, maybe get a loan against the house and then buy an investment property, something that could build generational wealth, something that Keller Williams really likes to emphasize, right? So a lot of equity in America right now, I think, means a lot of opportunity.
Amen. Love that. Here's the other thing that I notice is when I look at this whole rate lock conversation and you say, okay, well, who are the people who are 4% or below? Well, that's only about a third, right? So we've got about 40% that has no mortgage. Then we've got, this other, 30% or 25 or 30% that's 4% or higher, and then we've got this smaller group that will continue to shrink. And Luke, what are some of the ways that group's going to continue to shrink, other than just them selling their home?
When you say that
the group that's 4% or lower in interest rate. So if they're 4% or lower in interest rate, how are they going to then have a higher interest rate in the future?
I got you. I think I understand where you're coming from, which is in terms of other debt. Are you saying other debt accumulating and things
Amen.
like? Got it. So things like credit card debt, auto loan debt, all these things that have really high interest rates can create a landscape where the blended interest rate is higher than maybe 3 or 4%, right? If you're also battling high credit card, high auto loans, your interest rate isn't really 3 to 4%. It's a lot higher than that. So I think what Michael's getting to is there's an opportunity to potentially refinance that and have a blended interest rate that's a little bit lower. Even if you refinance and your interest rate on the house is maybe higher than 4%, could be an opportunity to consolidate debt and reduce the total interest rate.
Absolutely. Do you know anybody who could help people with a refi?
I think I know one company
just
in particular.
check. Yeah, just checking. Well, if you know somebody. Here's the good news is, hey, as money gets tighter, which the money supply's tightened, right? As costs go up, things get more expensive, people typically don't stop spending, so they're going to accumulate more debt. So to Luke's point, if you got $50,000 or $60,000 of credit card debt at 17%, maybe you've got a $25,000 car loan at 8 or 9%. That person says, hey, I can wrap all this into my home mortgage. Yeah, it's at 6.5%, but that's way better as a blended rate on the total expenditure monthly, right? Now that person is no longer rate locked, right? So interesting to know the facts and the data. These people that are, oh, well, everybody's rate locked. And everybody's not rate locked. Okay, Affordability. I think this is really interesting because when you look and you say, okay, principal and interest as a percentage of income. So that's the yellow line here. So the yellow line, which varies, but it's showing how much as a percentage of your total income are you going to spend on your principal and interest payment on your mortgage. And what you can see is you can see the historical average, and this is the green line here, and then you've got the purple line, and this historical average goes back about 50 years, okay, to 1972. I can tell you that's 52 years. And then you've got historical average, right, which is a shorter term here in the purple line, and that's about a 20-year, 25-year period of time. And what you see is you see that we've had a lower mindset created because of the interest rates between about 2000 to 2020, and then we've got this higher cost now. So it's creating more of that uncertain feeling from people that like, oh, I feel like I'm paying more, and it's just because of what's recently happened. But what we see here is we're only 8% above the 50-year line, right? Okay, so yeah, it's more, but not drastically more, right? When you look at your total budget and you say 8% of that total budget, I mean, that's something that's doable.
Yeah, one thing I'd love to add as far as affordability goes, there are three main drivers in housing. There is employment, which we already talked about, 4.6% unemployment, that's in a healthy range. There's demographics, if we take a step away from macro for a moment and think where we are, Atlanta, a lot of opportunity, favorable laws, great climate. So demographics check, people are coming here. And then there's the tertiary pillar that is affordability, which as interest rates start to come down, that'll be alleviated and help drive housing. So I just wanted to paint that picture of the three pillars, and that affordability is the one that's a little bit more stubborn than the other two for us, but will hopefully have some alleviation.
Tertiary, that's an ACC word. All right, so months supply of inventory. We've got new homes are in red and existing homes in blue. So what you see here is you see the amount of supply. So you say, well, gosh, there's a lot of supply in new homes, not as much in existing homes. So what's driving that? What's causing there to be more supply? Well, first of all, the builders listened to the low supply, so we can see this. They listened, there's not enough supply. So the builder said, hey, we're gonna build more. Wonderful. So now we see more new construction, right? Which is awesome. Then the existing homes, we're seeing, man, the existing homes. So there is, as we talked about, there's about 30% of people that could feel rate locked, right? I've got this amazing rate. I'm not going to sell my home. So there's some of that. But also the other piece that's depressing or suppressing the amount of existing home inventory that's in the market is the funds, the REITs, the hedge funds, the investment companies, and that kind of thing that are buying existing homes in mass, right? So there's a lot of purchasing that's happening there relative to the existing homes, and in particular, which is not great for our economy, the starter homes and the more affordable homes.
New home starts. The big thing that stands out in this graph is the Great Recession. You see a big plummet on new home starts right around 2008. Since then, there's been a slow recovery towards a more balanced, new home start equilibrium.
Amen. Love it. Yeah. This right here, it was the builders, it was the developers, it was the land purchasers, everybody. The banks stopped lending, and not only the banks stopped lending, the banks sued a lot of those people, and those people had to go out of business or bankrupt or foreclose and all this different stuff. And so it took a long time for the new construction to rebound. And what we see is new home starts has come back to the median level, which is great.
Yep, we see that same reflection here in new homes sold. Great Recession, and then slow recovery back towards a more balanced level towards the median.
Love it. Cool. And home sales. So this is projected for 2025. There is forecasted to be a slight increase over 2024 home sales, and this is an aggregate. This is total home sales. There is forecasted to be some increase. So what we're going to see based off this is a really strong late spring, summer, and even into the fall market this year.
Home prices. This yellow dotted line, that's the trend line. You can see that over time, we are continuing to follow that trend line as far as home prices go. So this is something that I don't think is a concern. We're still there. And like on a previous graph we mentioned, 2025 is still evolving, right? We're just in the first quarter. So we'll see that number change over time. But even still, it's following that trend line beautifully.
Yeah, that's good. It's good to see it kind of returning back to a little bit more normal. All right, home values. All right, so don't freak out. Okay, all right. This number is projected nationally, okay, all right, across all major metropolitan areas. Now, what we've seen the South, and we've seen in particular the Southeast, remain more stable and grow higher in the growth years and remain more stable as some of the other areas of the country have pulled back a little bit. So this is a projection for national number to pull back maybe 2%.
Yeah, can we go back to that one slide really quick? I also just want to point out that we had 3 years where the growth appreciation was 38%. Just in context of affordability, again, I want to share that when home prices appreciate that much, you also see things like homeowners insurance and property taxes increase. So that's one more demonstration of just affordability being that last pillar that we're waiting on to really drive housing.
Love it. Thank you. And this is illustrating what Luke just mentioned here. And you can see in Georgia from Q1 2020 to Q4 2024, 64.8%. So basically a 65% increase on the most valuable asset that most people own.
Median net worth between owners and renters. This should be staggering, right? We see a massive increase in net worth or a higher level of net worth for those who own a home. What I think is even more powerful than just that is that from 2022 to 2025, the median net worth for renters decreased. That being said, for homeowners, increased. So I think this is a conversation to have with those who are maybe on the fence between renting or buying, and share that home ownership can really buoy your net worth.
Amen. This will be in your takeaway slides. If you know people that are renting and they're telling you, oh, I just want to rent, this could be a powerful conversation starter. Okay, we're going to run through this pretty quick. You want to start off, Luke?
Sure. Yeah, we expect that GDP to slow down a little bit. 70% of GDP is consumer spending, and we're already seeing consumer spending to start to diminish. Big reason for that, I think, is debt. Debt is really, really high. Credit card debt, like we mentioned. Federal student loans are now becoming a role player in this. So as we see consumer spending as well as government spending reduce, we're going to see GDP slow.
Yeah. Love it. Inflation, is it going to pull back or is it going to push higher? We saw that there are forecasts that it will continue to pull back. There's kind of some competing things going on right here. So the tariffs are expected to push inflation higher because tariff in its nature. So a tariff is a tax on imported goods designed to influence trade, protect local industries, or generate revenue. So the tariffs being in place makes things cost more that are coming into our country. So that is expected to push inflation higher. And to Luke's point, consumer and government spending decreases are expected to pull inflation lower, right? To lower inflation. So we'll see how those play out. One thing that has happened, whether you like them or not, I'm not, but the tariffs, there have been between $4 and $5 trillion of pledged spending of companies that are saying we're going to spend this money in America now instead of spending it overseas. So we'll see how that plays out. It hasn't happened yet. And then just be aware that an economic recession is a possibility, but remember, again, in context, it's not a horrible or an awful thing. It's not a great thing. It's not what we want, but we've been there before. And what we find is that during recessions, homes become a place of stability for net worth that people move into when there's uncertain times. So that wraps. Thank you, Luke.
Yep,
and
thank you.
Let's jump into our commercial real estate segment. Rocky Kaufman.
Okay, first, again, as usual, I'd like to thank Charlie Lockwood for helping with some of this information and talking through some ideas for what we're going to do later on after this today. Little side note, obviously Charlie's got a big advantage because he's been around a long time. Back when he was in high school in the 50s, they actually didn't call it history, they just called it now. So if you look at this, it's interesting because you've got, again, we've been talking about office for a long time. You see the negative absorption, and you're wondering, why are we still building office while we have this negative absorption? Look at the growth of rent over here. So you've got a mixed bag between all these categories, but in all of them, there's things that look really awful, but at the same time, it's the real estate in Atlanta it's really not doing that badly. So the reason they're still building and the reason you've got rates increasing is because businesses have the money for the rent and they want nice space. The reality is that younger people want to work in a nice office. So where the struggle is those class, C properties, B minus properties. There's a lot of vacancy, and that's going to continue to be a problem. But you're seeing new buildings coming online, and you've got businesses that are willing to spend $40 a foot plus to be in them. So vacancy is going to continue to be an issue for really another couple of years at least. But I think that we have hit the bottom of the trough. As a side note to that, Scott Morchauer, who I think is in the room somewhere, was actually mentioning, hearing a lot of the private equity guys are actually talking about what we've talked about a couple quarters ago, which is the inevitable move that people are starting to buy office. And you've seen it in the papers. You can buy it cheap now. So you're seeing a lot of the money move into that sector because that's the opportunity. Retail is the strongest of the categories. Vacancy rates are decent. You've got the rates still increasing. The story from years ago about big box, it's still a thing. Big boxes are dying, but everybody's moving to these more boutique sort of retail centers. Your strip centers are very strong right now, and they're going to continue to be. Atlanta industrial, similar sort of a thing. The big, the million square foot centers, Amazon's not moving into anymore, but we actually need more small warehouse space, industrial space throughout Atlanta. So you're starting to see some construction that's going to be coming online, and that stuff gets rented out easily. Multifamily, nationally, this is one of the few areas where nationally is doing better than we are. And the reason is we just overbuilt. The builders got very excited for a while, and in particular in town, you saw multifamily going up everywhere, so you're seeing decreasing rates. You're going to start to see the tail end of that. So you're still seeing things coming out of the ground now, and because they started some years ago, you haven't seen new properties be scheduled for redevelopment at this point. So that's going to all start to even itself out. Under construction properties, again, you can look at this. I'm going to kind of hijack where we are with these slides. I'm going to move quickly through these today. I do think that you should all look at some of these things that I'm not going to spend I'm not going to put time into, because I'm going to talk about the investing in our city as a whole a little bit. But I am going to talk about first West Atlanta. These are all of the restaurants that have been closing down. The last several years, really the last decade, if you had a restaurant owner coming to you looking for existing restaurant space, incredibly difficult to find. Now all of a sudden in West Midtown, and there's some debate as to why. I mean, certainly since COVID, some restaurants have struggled. Prices have increased. In some cases, fewer people are going out. But is this a story that's just about West Midtown and them overdoing, all running into that area with new restaurants? Or is there a bigger story here about restaurants in general? It's something I think we're going to need to watch and keep an eye on what's going to happen at West Midtown. I'm not predicting this, but very often when you see an area that's been hot, one of the first things to go down is restaurants. So you kind of have to watch to see, is that going to be an indicator of that explosive growth over there is going to slow down? So in spite of what we just talked about, which is overbuilt apartments, here's apartments being built. But what's interesting is they're renting out fast. And I think that it's a little bit kind of like what's happening in the office world. Like if you build these big, really nice apartment buildings, you're going to be able to fill them up. But then you're leaving this hole where some of these older buildings are. So it's going to take some time to clear that out. Even as far out as South Forsyth, you've got these kinds of projects going on. Again, I encourage you to look through these slides and Google some of these projects yourself. I'm not going to spend a lot of time on. Pretty interesting things going on. The tallest building built in Atlanta in over 30 years about to come online. Which again, interestingly, you've got 8 stories of office, you've got retail and dining. So in spite of some struggles that you see all of these new properties coming online. So this slide and the conversations I've had to prepare for what we're doing, the economic roundtable we're doing after this, really kind of had me look harder of everything that's going on in Metro Atlanta. So Atlanta is arguably the big city for big sporting events. So we've got major leagues are having the All-Star game this year. We've got SEC championships and NCAA playoff games for football. You've got March Madness here. You've got World Cup coming here. We've got Super Bowls that have been here and are coming back. So you're hard-pressed to find another city in the United States that has as many big sporting events as we have. And a lot of that, there are so many things that quarter after quarter we've brought up examples of. Last quarter I talked about data centers that are coming online because of our infrastructure here. Previously we've talked about the impact that Georgia Tech has had because Atlanta is a tech hub. So if we're the sixth largest city in the United States. We're finally getting some of the due that we've deserved. We've got Michelin-rated restaurants. We've got one of the busiest airports in the world. And my point in all of that is, I can go down this really long list, is I for many years have been asked, why am I really focusing all of my investment and the investment I'm pushing on my buyers and investors in Metro Atlanta? And I think the conversation is easy. We have all of these things. We are in a great position to continue growing. So why would I look to go outside of that? And I think that obviously, those of us in commercial real estate, we're looking at it from the commercial side. Cheever stole a little bit of my thunder here at the very beginning because I was going to talk about what is, for most people, where is the majority of their wealth? In their house, right? So while I'm looking at this from the commercial perspective, all of you in residential, you have a great opportunity that I feel like people don't talk about enough, which is you're buying a house in one of the fastest growing cities in the United States and one of the best places for potential real estate value growth. So that's the big story. That's what I think you need to take away from all of this construction, all of these things going on, all these sporting events coming in. You're helping people become wealthier if you're helping them buy a house in Metro Atlanta.
I love that. Yes. Because, can I just start with encouragement? Anybody need a little pep, a little fuel up this morning, okay?
Because all we do is win.
Yes, we are winners in this room, okay? If you're here, you're a leader. If you're here, you want to win. You've positioned yourself to win. And we know it's hard. This is not easy right now. Some of us are dealing with some really difficult areas in our micro markets,
which we're going to talk about today. And just really quickly, hi everyone, good morning. My name is Cara Epstein. I'm the team leader at the First Atlanta Market Center, and I am joined by the lovely UnDMA, team leader in the Peachtree Road Market Center. And we are so excited to bring you the local data because today we are diving into micro markets. So we're going to give you the Atlanta metro area, but then we're also going to encourage you, just as we've said earlier in national, to dive a little bit deeper into the areas that you are focusing on.
Absolutely. And let's start with top market share. Okay, because number one, Keller Williams, again, as we usually are, 17%. Across market share, with more market share than the next three companies combined. Now, I've been up here speaking regularly on our market, and I'm also competitive. Anybody else competitive?
Yes.
Okay, so that number last quarter was 19%. Now, we're not going to let anyone have an advantage, are we? No. So we're here today because we're going to talk about skill, because that's what this is, and we're going to go deeper into strategy. But 17% is excellent. It's more than the next three combined, but we want to be better than that. Yes?
Yeah. And who doesn't want to work for the company with the number one market share? I mean, come on.
Absolutely. And I think our actual greatest value proposition, and I hear this all the time in talking to top agents, is the collaboration piece. We do more list and sold sides by the same company than anyone else, y'all, by 24%. The fact that we are an organization that is collaborative, we're in the room with top talent, we're hearing from top leaders, is so important. And it's not the same everywhere. Not everywhere wants to share what their winning strategy is. So I think that's huge. Congratulations.
That is a great point. So we're going to dive straight into it because there is a lot today, and you are going to see a through line of challenges happening in the market. So what this slide is showing you is it explains what happens in a peak buyer's market, a peak seller's market, and also where we are today, which y'all, it's still a seller's market. So for those of you that are going, okay, well, what does that even mean? I keep hearing peak buyer, peak seller. What does that actually mean? In a peak buyer's market, what you're going to see is massive supply. As a result, you're going to see low demand. You're going to see more distressed properties, which you'll notice we're not really seeing. Really, we're not. The conversation's happening a little bit more, but I'll tell you the data doesn't reflect that it's a thing. You will see more price reductions, even more than we're feeling now, and then you're going to see a lot more days on market. So some of you are like, listen, I'm starting to feel that in my micro market, but on the whole, we're still looking more like a seller's market, which again will tell us that we've got less supply, more demand, which means less days on market, less price reductions, et cetera. What I want to draw your attention to is inventory. That first line, I mean, you are seeing just more choices. Buyers have more choices. And for some of you, you're also going to feel that buyers have become a little bit pickier. As a result of interest rates, inflations, all of the things that we're talking about, you have buyers in this market that are also saying, I maybe have less cash on hand to renovate. And so some of these options are sitting on the market a little bit longer, and that might not be because of pricing. That might simply be because buyers are looking at how they invest their dollars differently. The other thing I want you to notice, which is just down to the bottom here, percent price reduction and percentage of failed listings. We're going to invest a lot of time on this because what you can see is 39% of properties had a price reduction. More than 1 in 3 had a price reduction. And at the same time, now you're going to see 32% of listings failed. Hi, show of hands, total safe space. Is anybody here that's got a listing on the market? It's not selling, it's not moving, and you're worried it's going to fail? Yeah, thank you for being honest. Y'all, we get it. Like today is real talk, real information, and we are hearing you, right? You're having to work so much harder, and part of it is because we're struggling with price reductions, and then homes just not making it, you know, off of the FMLS, to be honest. So the other thing that we're going to look at here is even though we have a greater amount of price reductions and failed listings, it's still a seller's market. Okay. On our next slide, what this shows you is we're going to compare from all of last year broken down by quarter, and we're going to look at Q1 of last year to Q1 of what we're looking at this year. What you will see, and much to what Michael and Luke said earlier, we are seeing homes appreciate maybe 1 to 2% over the next 6 to 7 years. What that also means is that the last time that we saw home prices drop heavily was 06, 07, 08. I mean, y'all, that's recession talk, right? We're not there. And while we understand that prices, especially even in your micro markets, might be plateauing, they're not going down. So if you've got a buyer that's sitting on the side right now because they're waiting to time the market, we get to have this awesome conversation with them which goes, hey, you don't need to time anything anymore because we are seeing a steady appreciation of home prices. And more specifically, let's say, for example, you live in Brookhaven and you live in this pocket, this subdivision, maybe you're in Drew Valley, Ashford Park, we're actually seeing homes that appreciate closer to 6 or 7%. So your area that you are in is actually appreciating at a higher rate. By the same token, maybe you have somebody in Vinings and their home prices are not appreciating at the same rate, but they are still appreciating. This is the conversation that we get to have. So again, I know our clients are waiting and they're timing and all the things, and now is the best time, truly, because we're not expecting prices to fall maybe like we did last year coming into this year. Does that make sense? Yep. Awesome. Okay, so let me see if there's anything else. Yeah. On the seller side, we understand how to have a conversation with buyers, right? Jump in, you can't time it, all of that. But on the seller side, we do also have the responsibility. You'll say, I say responsibility, not opportunity. We have the responsibility as well to set the expectation that appreciation has softened. And so while I can appreciate, Mr. and Mrs. Seller, that you feel your home is worth X, what the market is telling us is that it may be closer to Y. Now that's still so much higher, right? You still have the opportunity to walk away with X amount in your pocket, right? Here's my net to seller sheet. But what we're doing is we're just reframing their thinking, and we're helping them understand exactly how much more their home is worth than when they bought it. And we're hoping that's the case, right? Because that makes that conversation a lot easier. So that's really, I mean, those are the big things that we take away on here, right? We've got active listings have gone up, a little over 10,000. Supply in months. So shout it out. Who remembers how many months of inventory makes a balanced market? Y'all, good job. 6. What you're also going to notice is that we're looking at 3.9 months of inventory. We have not had this conversation in a really long time, but again, it comes back to a skill set, and it comes back to what's truly driving that number, which is a whole number of factors we're going to talk about. The other one on here I want you to look at is days on market. So this time last year, we were talking about 26 days on market, right? So I'm right here, median days on market. Now we're talking about 46 days. Hi, show of hands, who's feeling days on market right now? Because, yeah, that's almost this entire room. So again, this is a conversation. These are the numbers that we're looking for in addition to price reductions and failed listings, is that median days on market more so than price.
And when we look at overall sales, really, we're really down about 8%. So if you go to the next slide, we can see, year over year, 8% isn't, nationally, we were supposed to see a little bit of an increase in sales, right? Which I still think we're going to accomplish. But I think some of that is the uncertainty. Are we feeling that with our clients right now? Just a little bit of uncertainty, a little bit more on the terminations. Anybody having more terminations? So I think some of that slowdown is in conjunction with that.
Absolutely. Now this one's really interesting because we talk about sales to original list price, and y'all, we are in spring market, and so we're saying, hey, where are our multiple offers? Where is all this interest? And for some of you, you're going to feel that again in your micro market. But what we're seeing as a whole in Metro Atlanta, and just a reminder too, here's your caveat, this is for single family detached. So this is not factoring in condos or townhomes, this is single family. And when we look at this, we're seeing that it's about 28.9% of homes sold at or above list price. That's great, right? And what about the 71% that didn't? Yeah. Oh, I felt that for some of you, right? So 71% of homes. Now, could it be that we're overpricing? Could it be that buyers are pickier? Could it be all of the things, right? But just understanding that this is an opportunity, and when you show up, because this is another opportunity. When you show up and your sales to original list price is higher than the market, I want you to shout it from the rooftops. That should be in all of your marketing. When your days on market beats your hyperlocal market, shout that from the rooftops. But at the same time, take this into consideration because now, and in a lot of areas, your list price is not your starting point. So you've got an opportunity to negotiate at a really high level, be the economist of choice for your clients, and bring another perspective.
Yeah, and when we dive into that deeper with numbers sold by price range, the interesting thing I'm seeing is look at our luxury market. Okay, so we're seeing an increase there up by 11.1%, but in all other categories, this is why we're saying the word micro, because some of you in the room, aren't feeling what a lot of you are feeling because of the area that you focus on. I know Jenna with East Cobb, you're dealing with, you're selling it like hotcakes, over asking, all the things happening, but then go over a few miles over and maybe you're not in that same perspective. So looking at these price ranges, you're going to see that we're down 8.7% overall in sales.
I love it. For some of you that have been in the business for a minute, this phrase is going to sound familiar as well. We have an opportunity not to be an order taker, but to be a consultant to our clients. And I say this with love and respect, but a lot of us are going out there when we're being order takers. Yes, Mr. and Mrs. Seller, I agree. That's the price, Mrs. and Mr. Seller. This is what we're going to do to get to that price, Mr. and Mrs. Seller. I'm going to invite you to be a consultant. Hey, I can appreciate where you're coming from, right? I got a listing and it's $750. It really should probably be closer to like $715. And the reality is, here's what the data shows. Here's what the market tells us. And throughout here, you're also going to see the days on market in which that price point changes so quickly and how important it is to move from being order taker to consultant.
Looking at our sales overall again, we're down about 17%. So if you look at the areas where we're between 300 and $1 million in sales, We're seeing that decrease there. And then look at our luxury market. We're seeing that we have better sales, 13% in that million to 1.4, 1.5 million and above.
Okay.
But here's where we have a great story, is our annual median sales price, okay? We continue
to turn it around
here. And this is huge, because when you look at the data here, from 2011 to now, we're at a 250% increase. Guys,
Yeah, I think that I'm going to take this win where I
really
can, only because we know what's coming next.
That's a really big deal. So even over, where we were in 2024 to now, we're still seeing an increase, even with the other variables. So this is a high point to be able to focus on with your client.
Absolutely. And again, prices are not coming down. There is no timing this market. Get in the game. And to that point, we're going to start to talk a little bit more. We know price is stable. We know that's good. But then we get to talk about days on market. And again, that's one of those things that you're feeling. So median days on market has gone up year over year, 53%.
Okay, pause on that.
Yeah.
53%.
What that actually means, that if we take that percentage and we put that into days, that's an additional 18 days.
Which feels like forever. It does.
I mean, but really, because we talked about this, and we know this, it's just another day you have to have another conversation, or another day you're avoiding another conversation. And what this is
another
also,
day your client's getting the house ready to prepare, to show ready every day.
The thing too, though, is like your buyers are telling us whether they like the home or not. And so there's not necessarily a convincing of someone. It's either going to be a fit or it's not going to be a fit. Now, again, micro market, your days on market, like we're saying, hey, take a look at this, median days on market from 500 to 749. There's an increase in all price ranges, it's all gone up, et cetera. But some of you might be saying, I'm in a pocket where this stuff is flying, right? To your point, if I'm Jenna or Trey and I'm in East Cobb or I'm looking in Walton School District, yeah, we're gonna feel an urgency, right? And at the same time, there are some areas where you're like, man, this should be moving, but now I'm coming up against new construction that's offering incentives and money and these things, and now a closing and this, and then you go, I just can't compete, or I'm chasing it down, right? And that's a conversation that I get to have with Raphael and Paula about listings that they've got in areas where listings should be flying. So just understand, days on market, yes, we're going micro, but on the whole, they're up, and that is something to watch out for. Again, now, price reductions, and bear with me because we're going to talk a lot about price reductions. 49% of listings, which is half of all the listings, took a price reduction. That is up 8.7%. So if you've got 4 listings, at least 2 of them are taking a price reduction, 2 of them are sitting longer than you want to, and 2 of them require really heavy, fierce conversations. Now, what you're also going to hear is, we're not saying price it right the first time. With all due respect, we get it. Pricing is hard right now, right? And your ability to pivot and adjust is what's going to set you apart. Your ability to have that conversation, and heck, have that conversation before it becomes a problem, that is what's going to set you apart. The other thing I want you to see on this slide is, sure, we have an outlier here under 100,000. Do me a favor, push that to the side, but I want you to look at the rest of the price points. We're actually seeing this issue with price reductions in all price points, whether you're in luxury, midway, or you've got that first-time home buyer coming in and they might be in a 250 to 300,000. We're seeing it across the board. The other thing is your first 9 days, statistically, your first 9 days are the most vital. Now, we're going to talk about a 12-day plan here in a minute, but your first 9 days are actually the most vital, and that's when you're going to get a real sense of a conversation that's coming. But there's one other thing that I wanted to talk about, and you and I talked about this too. Something that we're hearing more and more from y'all is that we're showing up to a listing presentation with a price, right? And our clients have a price in mind. But here's where I'd love to give you a reframe and create a different sort of framework for the conversation that you're having, which is, we're going to go in and we're going to give a range, right? We're going to give someone what's called a go-to market price versus a listing price. Why? Because we're the economists of choice. We know our numbers, we know our market, we know that the market fluctuates, and we know that on any given day, competition on the market could close, create a new comparable sale, and now our list price is no longer relevant. So instead of pigeonholing yourself in with a specific price, make sure you're giving that range and understand that the price so a lot of times let's say for example the house is worth $750, we're going to say, Mr. and Mrs. Seller, we believe that this house should be listed anywhere between $750 to $800. Has anybody ever done that? Okay, yeah, I'll say it, I'm guilty, I've totally done that. And what would it look like and how would we set ourselves up for success if we actually said it was more like $725 to $750? So again, just thinking about that, how we frame the conversation and making sure we don't get stuck in a bind where we're painted into a corner, give a range instead of actually just giving a single price point.
That's a great strategy. And also, our favorite bold law, which we're going to bring up a couple times today, is focus on the plan, not the problem. The plan piece is so critical to being a skilled agent. You've got to have the plan going in. You have to know the numbers in advance. You need to look at that micro area. You need to understand the days on market, and then you need to have a plan. And I love the range, and I think the range is so important right now because of the fluctuation and the fact that things are happening real time. We're seeing increased days on market happening like while you've already been on market. And so you've got to be willing to make those pivots, as you said, and make a shift quickly, but you've got to lead your client through that conversation.
100%, because here's the thing, y'all, when you sit down, set the expectations, and you have that, you've actually given them a plan. You've shown that you're a professional. Here's the strategy. Here's how we do this. When we get midway through, and now we're on day 16, and we're starting to have this conversation, what we've done is given them a problem. And so we get upset because they view it as a problem. They shift the blame to us. Well, we can't blame them for shifting the blame to us when we didn't provide them with a plan to begin with. So Mr. and Mrs. Seller, we're going to know within 12 days exactly how the market feels about this house, but those first 9 are going to be really critical. We're going to start to have conversations because realistically, if the house isn't selling, if we don't have the showings and if we don't have an offer, then the conversation's going to sound like this on day 14. It's time to reduce the price. And like we talked about before, here's what we're going to do and here's how we're going to market that. And right, that's the conversation that we get to have. But again, if you show up with the plan ahead of time, before the sign is in the yard, before the photos happen, before anything, then you're no longer giving a problem that then becomes yours, where they get to second guess your ability as a professional. Do we feel like we could do that in this market? Awesome. Okay. We're going to keep going. So this one, we talked about the incidence of price reductions, so how many properties we're seeing have price reductions, but now we're actually looking at the amount. So again, go back to the listings you have, pull up the slide, pull up your price point. If you're thinking of making a price reduction, don't just pick a random number. Come and let the data have this conversation for you. Give this slide to your clients. Say, Mr. and Mrs. Seller, we're listed at $625. Based on what the data tells us for when we make this improvement, what do you think the price should be? Right? Give them authorship, give them ownership, and now they drive the conversation, and they're actually asking you to reduce the price. Yeah, that's pretty much that. Let's keep going. Price reduction effect. Again, when we know we have to take a price reduction, we know that days on market goes up. Like this is not crazy, right? But again, when we look at the data, and I just like to come as a midway point. So we can either price it where it needs to be, where the price matches the value and the condition, and you're 13 days on market. How great would that be? Like, great, we are on our way to the closing table, versus now we're at 111 days. Yeah, what you're noticing is that gap is getting greater. And that painful conversation that you get to have every single week, you're only going to feel more frustration. And again, you're giving people the opportunity to doubt your ability as a professional. Hi, don't do that. You'll know exactly what you're doing. Let's showcase that at the highest level. Any other thoughts on this, Andia? I mean, I know we talked about it being a skills-based market, and this is where our skills show up, but what thoughts do you have?
They do, and it's flushing it all the way through. So when we say plan, it's being able to say, this is what our market price is going to be. Then at 12 days, the market has told us if that's a price that they're willing to pay. And if they're not, then here's our plan. We're going to do X. And then we're all in agreement with it, and the expectation is set. So to your point, it's not a problem. You've already created the plan and set the expectation, and the objection is already covered. So you're not dealing with then the conflict and the rub, which creates what? Just additional stress for all of us. So I think the strategy here is really just having the plan flushed all the way out, very micro-focused on that specific area with that client.
Yep.
And that's where our ability to shine comes in, because I guarantee you the other conversations they're having are not going to look at that in depth and not planned out.
So take out those skills, take out the skills that you learned when you first got your license that we had pushed away because COVID was fun and easy, and all you had to do was walk outside and you got a listing like landing on your head and say, okay, what are all the things that I need to do? What are all the tools in my toolkit? And then get creative, because you might have to use them all. That's the market that we're in, folks.
And by the way, this may be a new market for you. No matter how long you've been in the business, we see different markets, cyclically over and over again, but maybe this is a new market for you and you haven't experienced it, and that's okay. Now's the time to sharpen those skills. Now, this is interesting because even though with the data we just gave you, we are still seeing seller-paid closing costs, okay? 65% of the time.
Wait a minute. 65% of closings had seller-paid closing costs. Hi, write that down if you haven't. Because that's the conversation you get to have with every single person in your database right now. Anyone that is thinking of selling, anyone that is thinking of buying, that's huge.
It is. It's huge for the buyer side, and it's also, again, consultative for the selling side, because you need to explain 65% of the time we're seeing concession on closing costs, and if you go to the next slide, it's going to tell us how much, which is about $7,500. So as the consultant, you need to plug that in that, hey, this is our market price. This is what you're going to look at in closing costs, expectation. At 12 days, we're going to see that if we're not priced right, they're going to tell us by not giving us an offer, and then da-da-da-da. So again, you're backing in those numbers so that you're giving that reality instead of throwing in a problem of, oops, by the way, now we're going to have to give seller-paid closing cost at $7,500. That's a problem. We want the plan.
Amen.
All right, listing history. We're going to breeze through this one. Guys, the green line is a balanced market, okay? So you can see where that is, and you can see where we're below and where we're above. So we've got interest rates are still a little above, but to what Luke was talking about, we're still in a decent spot.
And Andia, I'll tell you, at least from the agents in the field, we're not really hearing that interest rates are as much of a conversation anymore.
Has that slowed down for y'all, or is that still a super hot button? Slow down a little bit?
And here's the thing. The other thing is, are you making it bigger than it needs to be? Or are folks now settling into a new normal, and we need to encourage that and move on?
Very good. And then you can see there the sold is in red, and in gray is active, and months of supply you can see is increased up to 4.
Yeah, so again, steady, much like what we heard on the national side. Ooh, Andia, first 30 days.
Oh my gosh. Okay, so this is my favorite slide. Okay, because the first 30 days, right, we're amped up. We've done all the work. We've done the listing prep. We've put in everything. We get the sign up. We're ready. We got our open house strategy. We've done all the things. And then it's okay, what's going to happen? And we're all waiting for those results. So here we are.
I'm just giving a visual for you.
100%.
Yeah.
Okay. And as Cara told us, 39.5% of all sales occurred within the first 30 days. After 12 days, the sales to original list price, as we know, becomes volatile, but only 8.1 were reduced. So only 8.1% actually made a move after that 12 days. This is where you get to come in and shine. You can be better than that 8%, correct? Yes? And then in the first 30 days versus then 75% having to make that reduction after 30 days anyways. So this is your opportunity to shine. Be the difference, be that separator, that differentiator in the market.
Absolutely.
So if you're trying to win a listing, that is an area where you're going to shine.
Yeah, and if your numbers are better, showcase that. Use this slide to your ability. Hey, the market's doing this. I'm outperforming the market. My team and I outperform the market in all of these key metrics. So when we say, Mr. and Mrs. Seller, that we can actually sell your home faster and make you more money, it's not just a story. We actually do it.
Tell your story. Yes, that's so good. Show the difference.
So in telling your story, let's look at the numbers. Let's get real. Now, again, what's great about these Chartmaster slides, y'all, every one of our market centers has this. So shout out to the Rawls Group. Not all market centers have these. But you can actually go in and you can put counties, areas, and you can get that micro market to better understand all of the numbers so you can customize it to your client when you're meeting. But let's look. We've got a total of about 7,865 listings, and this breaks down the difference between when we have a price reduction and those that were reduced if they were listed before or not listed before, and then when we don't have a price reduction and if it was listed before or not, because y'all, expireds are hot. If you are not making the most of them, whew, now is the time. So let's just say, for example, we have a property and it's $500,000, it's $500,000. Look on the left-hand side with me and work through this with me, okay? So if we have to take a price reduction on our $500,000 home because we overpriced it, what happens is if it's been listed before, which is down here in your red box, what that is saying is based on the data, the original sales to list price, we're going to end up closing that home closer to $453,000. Yeah. Would it not have been easier just to price it where it needed to be at first? Now, if it has not been listed before, you're actually going to get it closer to $472,000. But the reality is how much easier does it make your job to list it at $475,000, potentially have 2 offers, and now we have a leverage conversation. And now we can actually potentially create a highest and best situation, or at least get more favorable terms for your sellers. You might end up at the exact same number, except everything else is better for your client. Now, if we go on the other side, okay, I get it. If we're looking at there's no price reduction, it's never been listed, I'm getting 100% sales to original list price, incredible. $500,000 was your price and way to go because you studied the market. But if it was listed before because you did your due diligence and you picked up an expired, you're looking at, I'm going to just double check my number here. Yeah, you're looking at about $6,000 off of that. So again, our ability or inability to have a conversation is costing not just us, but it's costing our clients a lot of money. And for many people right now who are hit by inflation, let's be real, it doesn't matter what your tax bracket is, the majority of Americans are living paycheck to paycheck. And I don't know about you, but I have absolutely lived paycheck to paycheck for a good majority of my life. It hurts. Understand that while $6,000 might not feel like a lot for you in this moment, and maybe it does, I hope it does, that could absolutely change the trajectory of someone's life, of someone's family, of someone's path forward, right? Maybe even their retirement. So again, yes, I understand maybe we didn't price it properly. That's okay. Pivot and move faster, okay? Now, we had a really fortunate opportunity to have a sit down with Phil Jones. For those of you who don't know him, he's the best-selling author of a book called Exactly What to Say. And we had a conversation with Phil in anticipation for this and talking about the market. And here's what Phil said. He said, sometimes all it takes is a simple swap. When you call it a go-to market price instead of a listing price, which is what we've been talking about, the whole conversation changes. Now you're a strategist, right? You're a consultant, and you're not a psychic. Now, if anybody has a crystal ball, I will absolutely take it. I would love that because that would make my life a lot easier. But here's the thing again, move from order taker to consultant. It doesn't have to be a set listing price. It can be a strategy and a range in the form of a go-to market price, okay?
Okay,
Oh,
the doom and gloom.
okay, yes.
I'm going to give you this, and then I'm going to give you something good. Okay, so total failed listings percentage, we continue to see, the increase there. We're at 39.3%. In 7 out of our 8 pricing categories that we've seen a continued increase.
So no one is immune.
No one is immune. We're still 8%, almost 9% higher than we were in the first quarter of 2024. So the failed listings piece, it stings, okay? And this is critical. It creates opportunity for some of us who have a great expired system. And then for those of us that are dealing with this, it's a challenge. Now, an area that I will tell you that you could immediately put another $67,000 in your pocket is becoming a follow-up boss of your own sphere. And following up is going to be more important and more substantial than anything else right now for you and your business. As realtors, we leave so much money on the table.
Amen.
And in fact, 90% of your clients would work with you again if you followed up with them.
This is a problem. This is a huge challenge, right? So loving on your database, heck, do you have a database? Where do you store them? How well do you know them? What information is actually in there to help you love on them, right? Oh, okay. Okay, so talk to us about putting it all together. When we've got 100 finalized listings, how does that shake out? What does that look like?
I mean, telling that story, 61 sold, 30 price reductions. So we're sitting at that 49%. Out of that, you're only getting 92% of that original list price, and then you're at 113 days on market.
Cool.
If you sold and you didn't have to make any price reduction, you're looking at 100% of list price, 14 days on market. But guys, only 31 of that 61 did that. So it's a very large number. The 39 that failed because of overprice, right, that then had to do the price reduction, 69 of every 100. It's a big, again, this is our opportunity. And it's not to browbeat, it's to truly give us the skills to be able to go, where's the gap that we can step in with skill and consultative conversation to be able to bridge that gap and win market share. Because other agents are not having these conversations at this depth.
And a safe space, like, how many of you, you're just kind of tired? Not coming into spring with this like renewed energy. You're like, oh, it feels like I'm working so much more. And the reality is because you're working harder. Truly you are. And we just want to help you work through that better.
And this is a perfect conversation to have. Correct pricing represents 80% of your marketing efforts. So I know how many of us have an awesome marketing strategy that we present. I should see all hands up. An awesome marketing strategy that we present, right, to win our listings, but 80% of that is pricing it right. So that conversation should be the most important conversation.
So it's not the tickety talks and the IGs and all of that's going to do it?
The plussing. That's the plus 10x. But the meat of it is the 80%, right?
Yeah.
So guys, this is the slide you bring. It's a consultative conversation. If we're going to be in the market and we have great condition and we have great pricing, 14 days on market. Mm-hmm. Condition's a huge conversation. Huge conversation. Do they need to invest money in repairs? What needs to be done? Is it clean? Let's just talk about clean. Let's talk about baseboards for a second. Windowsills, okay?
Take it from someone who has bought a home recently and is currently listing a property.
My fingers are bleeding at this point, okay? There's been a lot of work put in.
I just picture you on the
Yes, exactly. Okay, so 31%. But if we are chasing the market, we're going to be at 113 days on market. And then there's a chance we could just be overpriced and out of the market. So this is the slide that you have that conversation with. Yep. And oh, by the way, you have your plan attached to each one of those.
And now we no longer have a problem because we're chasing and we're continuing to have this conversation. And I don't know about you, but I love my heels and I don't want to chase anybody in heels. So yes, that's about it. I keep going back to this, right? And just like I have this math equation, which is just correct price has to equal value plus condition. Like, please go back and have that condition conversation. I know it can be scary and we can be fearful around it. And how might we pose it as a question to our clients? How might we actually say, hey, if you were buying this home, what's one thing that you would want differently? And while you've been in the home, what's something that you wish was different? Or what's a project that you've been meaning to work on because you know it would make your house better or would help you enjoy the home more that you've put off? Okay, great. And could it be possible that the next buyer is going to feel that way too? Amazing, and I completely get it. So what would it look like for us if we could actually just take care of that now? I'll go ahead and partner you with someone. We'll get a quote, because maybe it's not as expensive as we think it is, and we can take care of that. How does that sound? Again, take those objections, wipe them off the table so that we don't have to have that conversation because we've already gone to market with the wrong price.
So what challenges are we talking about today that we can help build strategy around?
Yeah, because there's a pattern here, right? And I know that we've kind of gone hard on it today, but the reality is that more than one of every 3 listings expired or was pulled off the market. And again, when we talk about leaving money off the table or impacting our clients in a way that they don't get to move forward with their lives, that's really big. And the other piece of it, again, is that nearly half of the listings that did sell needed a price reduction in order to go under contract. Guess what? It's okay to need a reduction. And it's okay to be human, and maybe we missed the price, but just make the pivot faster. And then lastly, something else we've seen is that 69% of the listings that came up in Q1 in the beginning of this year were in fact overpriced, at least initially. So again, don't beat yourself up for it, just get better because of it. And then simply said, those are the things that you're feeling, but your sellers are also feeling a downward pressure that they need to price it for the market because otherwise they're going to get this feedback that they don't want. So again, it's condition and value, and that has to meet with the price. But here's the thing, we're not going to give you the challenges and not give you some strategies. So let's talk about a couple of these, right?
Gotta have the strategy.
Gotta have the strategies.
Gotta have the plan, right? Gotta have the plan. So important.
So if I had $1 for every time we said micro market today, I could probably buy a single coffee at Starbucks. And get really specific. If you don't know the area as well as you should, go get in it. If you feel like the area is acting differently, it's behaving differently than maybe it was last year, chances are the data has changed and movement has changed. Go back. Go back to it, and then do me a favor, present that to your clients and say, hey, you know what, it's interesting. I listed a property here about 6 months ago, and this is what we were feeling in the market. But you know what, that was last year's market. Here's what we're feeling now, and here's what the data is showing us we can expect. So again, micro market, hyper local, however you want to explain that, just hone in.
Yes, in our organization, y'all, we are built on systems and models. That is why we are so good, because we have systems and models. So doing the work before the work is your model. It's your system. It's what are you doing to plan, to be ahead of the game, to have your systems, and systems scale. So if you're feeling like you're hitting a ceiling right now, it's probably because your systems are not in place to where you can scale. So doing the work before the work is critical to making sure that you're getting your listings moved.
And a quick shout out to Abby Shepard, because she came and spoke to our agents, and something that she does really well. And if you're not doing this, y'all, write this down, do this. If you don't have it, I guarantee you a leader in your market center has it for you. It's a pre-list conversation, a pre-list pre-qual. Save yourself that extra 30 to 60 minutes at the listing appointment and set yourself up for success. That's what we mean as well by doing the work before the work. Additionally, what you got is that go-to market price, which we've talked about. Again, we're using different words to reframe our clients for them to hear us better.
And it's the checklist. The system is the checklist. Here's what's next. Here's what's next. So that when we get to that 12-day review plan, it's not a, what are you talking about? Oh, what do you mean we're going to have to make a price reduction? No, here's what's next. And at 12 days, here's what's next. And you're leading them through that process so that you have a solution.
I love that. And one of my other favorite conversations, and I talked to Trey about this the other day, this is really simple. If this is new to you, please write it down, use it, practice it. A really great way to review a 12-day plan with your clients, aside from saying, hey, I have a 12-day plan and being able to talk about it, is to say, Mr. and Mrs. Seller, here's what I said we were going to do when we listed your property. Okay, here's what we've done, right? So we said we were going to do this, and we did this. Here's what I'm doing right now to move us from day 6 to day 12, such that on day 14 we don't have to have this conversation. And here's what's coming next. Here's what I'm going to be working on next. And we've said this before, but now's your opportunity to go back to the client and say, and here's where you can help, right? I thank you so much. You went and did that, and that helped us get ready so that we could go to market with the best property in the best condition possible. Here's what I'm hoping you're working on right now, because this is how that's going to help us. You don't want to know something else that would really help us? If you were to go and focus on that while my team is focusing on this, that's going to ensure that we get closer to the closing table faster. So again, it's practicing those conversations. It's making them feel organic, making them authentic, but do me a favor, don't practice on them. Practice on us, practice on each other, right? But again, have a plan in place, and then sometimes get creative. So and how many of you were in the business around the recession time, just after the recession time? Has anybody heard or given a reverse offer? I hear it, of course. And yet I know we have some new folks in the room that have never heard this. Here's one way to think about a reverse offer. And no, I'm not saying where you're actually physically writing an offer, although that has happened. But now what you might be saying is, I've got a property. I know it's overpriced. We're on day like 35, right? And the data tells me that this should have sold maybe 10 days ago. And lucky me, I still have 2 showings coming up this weekend. I'm going to go to my seller and I'm going to get permission to let those 2 showings know that come Monday, we're going to be reducing the price. But we're going to give them an exclusive first look at a new price before the market gets an exclusive look at that new price, right? And I'm actually going to show up at those showings. Yes, I know, we got a lot to do, and I'm going to show up at those showings, and I'm going to help them understand what the new price is so that they can look at it with new eyes. And then they also feel like they're getting an exclusive look. They have officially beat the market. And what do we think that does for our agent relationships? And when they have an overpriced listing, because I promise they will, who are they going to call first to give an exclusive first look? So again, we're not necessarily saying, hey, go write an offer as the listing agent, but maybe there's a conversation you get to have that is more in line with a reverse offer to generate more activity. And now maybe you have 2 offers that, again, put you in the leverage point and give you more favorable terms for your clients.
And what you're hearing is just, what are your strategies? Have more strategies. Have more strategies to have more conversations. I mean, how many of us have had to go get the buyer? I mean, finding the buyer.
Amen.
What strategies are you doing in the neighborhood to help the neighbors say, hey, pick your neighbor?
Yeah.
Right? Like, what are you doing with reverse prospecting? Like, what does that strategy look like around that conversation?
All right, so we're going to move quickly now through supply and area. Andia, take us through these next 2 slides.
Yeah, so we've continued to see that increase in supply. We're at 3.9 months overall, which is up 50%. Okay, now obviously micro market, this is not the same across the board. So that's not the case in East Cobb. In different areas, it's going to be different numbers, but overall, we're up about 50%.
Yeah, and y'all bear with us. We got about 5 minutes left for local, and then we're going to head on into luxury. Tell us about this.
So again, you can see total 85 days on market. We're up 18% in actually every category here.
Now, for those of you who've attended before, we have our area map that shows up in your slides. And again, when you go back to your stats, right, when you go back to your Chartmaster stats, you can focus hyper-locally on those areas. But we have a phenomenal resource that I'm going to implore you to use. If you want social graphics, if you want area information, Brookhaven, Chamblee, Dunwoody, Sandy Springs, Gwinnett, I mean, you name it. This book that the Rawls Group gives us actually has all of it in it. Y'all, it literally has everything. So if you haven't downloaded this, come back to the presentation, download it, because you're going to want this information. Okay.
I'm curious, does anybody use this? Okay, as a lead generation
tool? Thank you,
tool?
Deanna.
Yes,
we
thank
appreciate
you.
that.
Okay. This is fantastic. This is an incredible touch, and it's beautifully done.
It's beautiful.
The Rawls Group gives this to us. There's no reason you shouldn't be utilizing that.
100%. Okay, so something a little bit different now that we're doing today is, in the past, we've gone into very, very specific areas, but again, we understand that not all of those areas are relevant to all of you. We have top 10, bottom 10 for each of these categories. We're gonna review number 1 for each, but again, come back in and use this as part of your conversation. So we know that sales are down. We've got that 7865 as the number of sales for the first quarter. What we're seeing is massive growth in Northeast Gwinnett. And then Cheryl goes, yes. And not unexpectedly, we're seeing that Vinings is down.
Yeah, so in same top 10 highest median sales price, Sandy Springs, almost 1.3 million, number 1, woo woo. And then bottom 10 is Southwest DeKalb with 245. Top 10 largest price increase, number 1, Dunwoody, 21.6%.
Also not a surprise.
West Atlanta, and the bottom is Southwest DeKalb, down 20%. Wow. Top 10 largest increase, Vinings, 33%. Bottom 10 largest decrease, South Cherokee at negative 25%. Brookhaven's in there too. I saw that down, number 2.
Yep, and 25%. It's interesting to see Buckhead's.
Oh, my area, West Forsyth, down. I see that. Okay. Great.
She's like, I'm feeling it every day.
Great. Top 10 lowest supply, first is Alpharetta, 1.8 months supply. Wow, that's interesting. So look at that, bottom 10, West Atlanta, 8.7 months. So see, clearly there's areas here that are not in a seller's market anymore. So this is why you have to be micro market focused.
And then days on market. Again, there is the general for Metro Atlanta, and then you might say, Cara, Andia, this doesn't make sense. So top where we're seeing shortest days on market is going to be Sandy Springs OTP. Again, you're seeing people that are going out. And then bottom where we're seeing properties stay on the market is actually going to be Northeast Cherokee. Now, bottom 10, if you've got listings in there, this is ammunition. This helps you understand if you're feeling like I don't get why, well, the data supports you, okay? And then we've got incidents of price reductions. So where we're seeing the most number of price reductions, not necessarily by how much, we're feeling that big time in Midtown, and then less reductions, much like we've said before for our folks that are selling in East Cobb, it is going like hotcakes. Again, multiple listing periods. So where we are seeing homes come back on the market several times, again, that's opportunity. Unless it's your listing that failed and you're not getting to list it again. So top 10, we're seeing East Cobb. And then bottom 10, where we're seeing more frequency for multiple list periods, is going to be Northeast Cherokee. Man, if you are not selling in East Cobb, you might want to be. right? Absolutely. Failed listings, again, a big part of the conversation. And set yourself up for success if you've got a listing coming up in any of these in the bottom 10. And then high least failed listings, again, East Cobb, and then Sandy Springs OTP, okay? So to recap, you have a really, really unique opportunity, we all do, to make our conversations count in a way that they never have before, because they truly do count, and they amount to dollars and cents that will make a difference in your clients' lives. But here's the thing, doing the work before the work, having the conversation, giving the plan, and not being the problem, y'all, these are things that you know how to do. And if you don't, that's why you have us. We are here to support you in that. And then Andia, our favorite bold law.
Focus on the plan, not the problem. Now listen, it's important to repeat these things because this is a mental game. This is a mindset thing for us, okay? We're entrepreneurs. Entrepreneurs lead themselves. If we don't lead ourselves well, can we lead other people well? No. So this is a mindset of getting focused on what our plan is so that we can avoid problems and create solutions.
Again, we're going to invite you to walk into a closing conversation, not a convincing conversation. And last but not least, skill-based market. Know your numbers. Know your market. Know what makes you a differentiator. Wherever you beat the market, tell that story. Because if not, someone else is going to tell theirs louder, and it might not be better.
And you have opportunity. In every one of these slides that we talked about today, there's opportunity for you to take more market share, to follow up with your people. Put $67,000 back in your pocket this year just from incredible strategy around follow-up. Do the work, set the standard, but you guys in this room have the opportunity to shift and move the needle on taking market share because I promise you, other agents in this industry are not diving this deep into the process and sharpening their skills in the way that you are. So you've got opportunity, go for it.
Love that. Set standards with yourself and set expectations with your clients. Y'all, thank you so much. Up next, we have the lovely Courtney Gardner, who's going to talk to us about the luxury market. Let's give her some love.
You can take the girl out of Cleveland, but can't take the Cleveland out of the girl. Hi, everybody. Woo! Thank you for coming and getting down and nerdy about statistics. We love that, professional real estate agents. I'm Courtney Gardner. I'm completely blinded right now, so if I look like I'm looking at you, I am. I work with Live Luxury for the Southeast region with the illustrious Kay Evans. Thank you. The grand dame of all things. Let's just get into it. So, Andia, we didn't go down. Luxury, our market share is outpacing non-luxury or pre-luxury, what we like to call it, which is really nice. Don't let anybody tell you you're not number one in luxury, because baby, you are. Globally, nationally, locally, get into it. Now, we've seen some changes here in this level. You saw that the 750 to just under $1 million was a really hot market, maybe for the past 2 quarters. That's pretty traditional. You will see maybe from midway here and lower to see movement in the back half of the year. You will see your higher net worth individuals make their movements in the front half of the year. If you don't have a friendship with a financial planner, get with it. They start making their moves then. So if your clients pretty much are here, they're going to be done maybe early May with the movement of their money. They're going to be moving back half of May with the movement of their money. Knowing your avatars. I feel like I'm moving a lot. Sorry, guys. Some price reductions in terms of luxury, and we're going to get into the regular Live Luxury ones where we break them down by area. But this is a great slide to go through so you can see kind of what the price reduction penalty should be. And that's how you should be framing it for our kind of sellers that are like, you know what? I hired you to be a real estate professional, and I don't want to listen to anything you say. You have those, right? These are facts, not feelings. And it lets you reframe sort of that pitch to, it's not you and then me against each other. It's you and I together based on the behavior of buyers. And this is what they're doing. Make sense? It's hard to tell if you like me. I can't see your faces. The same thing you can do here is that you can talk about when those things should be happening. You will have so many clients going, oh, I just want to put it on the market and see what it does in 30 days. Ugh. We love you. You're not a real estate expert. You're a venture capitalist, different markets. Because we know that we should overall be under contract in 11 days. And if you want to wait 30, what you might mean is 157. And what could your life look like in nearly half a year? You're going to miss the start of school. You're going to miss the beginning of that. It's going to be in the middle of the holidays. Whatever the thing is, right? You can reframe that because that 30 days is a death knell. And the statistics tell us when you go over the case for getting it right, you're more likely to lose the listing than you are to close it. In luxury, between price reductions, multiple listing periods, it's about 70%. 7 out of 10. You've paid for pictures. They're expensive, right? So let's make sure, because it's your money too. It's not fake money. All right, so we're going to break it down by area. So while we know the buyer profile for a $2 million client is going to be similar, they're going to have similar education backgrounds, maybe similar work areas, those sorts of things. They all think they are profoundly unique based on their zip code. So, you know, the things people do. We wear expensive shoes, it's fine. So we break it down by area, and these are your top luxury markets. We actually just added a new version and combined Forsyth because, does anybody know what has happened in Forsyth? Oh, you should. It's the wealthiest zip code, or wealthiest county in Georgia. Oh, what it means is it's near a lake, right? Some of your clients that are in town in the wealthiest zip code are going to buy a house in the wealthiest county. Make sure you're paying attention to the movement of money. I love you all. You didn't know it. Come on. There's a quiz later. Okay. So the other thing you might be hearing is like, oh, well, what's the percentage that I should be price reducing, right? This is where you're going to talk about that. You're going to pre-negotiate that. If your client, during your listing appointment, when you're discussing that price range, wants to try to out-negotiate you, the person that they have hired to negotiate for them, make sure that you pre-negotiate the price reduction if they're being unreasonable, because you're more likely to lose that listing if it doesn't sell, right? Fair? And you want to see what that price reduction penalty is? So it's like 9% overall. And then on what day it should happen. Not day 30, not day 70, not even day 12, sorry, some of them, right? It needs to be under contract in 11 days to know that you're not chasing the market. When do you need to start negotiating a contract that you have before it actively goes under contract? About what day? Is it day 4? 4 days before 11? So if on day 7, you are not negotiating a contract, day 7 is when we reduce. Pre-negotiate that with real numbers. Make sense? The tale of two markets. I know you guys are sick of me saying it. I'm sick of saying it. There's a price reduction market, and there's a non-price reduced market. Cool? Loving it? Living for it? Scared of it? Yeah. Let's go. Well, that's the end of my day. Anybody has any questions, I'll be around. Michael Cheevers is going to come in and close for us. I love you all.
All right, so in conclusion, we heard a lot of great stuff today. I will tell y'all, I want to compliment on particularly everybody. I thought luxury was awesome, commercial was awesome, but the local really hit home for me. I was able to focus in on more of the key things, and I got more talking points out of it. So great job in the way y'all formatted that this time. Thank you. All right, fantastic. So in conclusion, March is done. We're in April. So we had our annual March to Fitness competition, and golly, man, I came up with this thing because like my wife was making fun of me for losing all my muscles and getting small. And I was like, I gotta work out and make my wife happy. And so I was like, what do I love to do? I love to compete. So I'm gonna make this competition and we're gonna put money and we're gonna do it. And I keep getting my butt kicked. I don't know what's going on. Anyway, we do have winners. And so we're gonna start with